liability method. We will explain this later. Now, this is a deferral, but this one is using income method. An advertising corporation received 120,000 on April 1, 2020 for a one-year advertisement. Income method was used upon receipt of cash. So that would be debit, cash, credit, income. However, no adjusting entry was made on year end. So 2020 advertising income is overstated. Unearned income is understated. So income statement, net income is incorrect because it is overstated. Balance sheet is incorrect also because you failed to record unearned income. Liability is understated, and since your net income is overstated, net income is close to retained earnings is also overstated. In 2021, advertising income is understated because you failed to recognize the income pertaining to 2021. Supposedly, this 120,000 should have been divided in 2020 and 2021. But since the full income was recognized in 2021, you were not able to allocate income to, the full income was recognized in 2020, when you were not able to recognize the allocated portion for 2021. So the advertising income is understated. As a result, net income is also understated. So your retained earnings account is now counterbalanced. Overstated last year, understated last year, balanced. And your liability is actually counterbalanced. Once you have earned it, supposedly by April 1, 2021, you have fully earned 120,000. And if you have fully earned 120,000, there's no need to record any unearned income. So there's no need to record any liability. So liability is rightfully zero. This is the same concept with prepayment under expense method. In this, these deferrals will eventually go to income. These deferrals will eventually be transferred as income. So if you fail to recognize or to record an adjusting entry, it does not really matter because at the end of over the period, all deferrals will be transferred to income. Okay, so eventually it will counterbalance itself. However, the same is not true if you have used the liability method. So correcting entry, if you have discovered it in 2021, debit retained earnings beginning. So because your retained earnings in 2020 is overstated, and your retained earnings end is your retained earnings beginning in 2021, that means retained earnings beginning is also overstated. So in order to correct, debit retained earnings. And then credit income. So kindly credit this amount. That's not actually correct. Credit income, credit this amount here. Credit income. Because if you remember, we failed to recognize the portion allocable to 2021. So in order to correct this one, credit income. But if you discover the error in 2022, there's no need for any correcting entry because again, it is automatically counterbalanced. So we're done with prepayments, we're done with deferrals. Let's now move on to accruals. In this case, we'll only include accrued expense. The same concept is applied for accrued income. So an entity has a labor workforce who is paid weekly. So every week they are paid. They are paid every Saturday of the month. So they work from Monday to Friday. They are paid on Saturday. The current year 2020 ended on a Friday. So your books are closed on a Friday. The entity forgot to accrue and record the week's salary expense. Supposedly, since your books are closed on Friday, you have an unpaid or accrued expense, which refers to the work done by your employees from Monday to Friday. So you should have recorded debit expense, salaries expense, credit salaries payable, but it was not the adjusting entry was not made by the entity, and the salary expense was only recorded on Saturday because probably because of practice, you always record debit salary expense, credit cash on a Saturday, which incidentally is now January 1, 2021. So analysis, The salaries expense and salaries payable is now understated. Supposedly, you're going to recognize the salaries expense and salaries payable for the amount of work done from Monday to Friday. So your income statement is incorrect because expense is understated. It follows net income is overstated. Balance sheet is also incorrect because your salaries payable is understated. Supposedly, you have a payable, which is Monday to Friday's worth of work. And then since your income is overstated, retained earnings is overstated. For 2021, the salaries expense is overstated. Supposedly, you're going to recognize Monday to Friday no work in 2020, but you only made the entry in 2021. So the work done on Monday to Friday was recorded on the Saturday, which is January 1, 2021, a new accounting period. So your salaries expense is overstated. It follows your net income is now understated. But your balance sheet, salaries payable is zero, which is actually correct. Okay, because by then, by January 1, 2021, you already have paid the salaries. So it's rightfully zero. And your retained earnings is counterbalanced. Overstated net income, understated net income, counterbalance. So if you have discovered the error in 2021, debit retained earnings, because again, if you remember, your net income in 2020 is overstated. So net income overstated, retained earnings end for 2020 is also overstated. Our retained earnings end for 2020 is our retained earnings beginning for 2021. So our retained earnings beginning for 2021 is overstated. So we should debit in order to correct. And then credit expenses. So if you'll remember, our expenses is overstated because we have included the Monday to Friday's worth of salaries. So in order to correct, credit. However, if the error is discovered in 2022, there's no need for any correcting entry because the error has now been counterbalanced. And now let's move on to counterbalancing errors. What are counterbalancing errors? Counterbalancing errors are errors that do not counterbalance regardless how periods have passed. It does not counterbalance until it is corrected. So if you will notice in our previous discussions, normally in 2022, there's no need for any correcting entry because the errors have been counterbalanced. Meaning, over two periods, the errors are counterbalanced and there's no need to have any correcting entry beyond 2 years. However, for non-counterbalancing error, that's not the case. So the income statement for that current year is incorrect. Immediately succeeding years is correct because it normally does not affect. However, there are certain cases that errors may affect the immediately succeeding year, but it does not affect the succeeding years. And your balance sheet remains incorrect until the same is corrected. Most common example for non-counterbalancing error is the depreciation. An entity erroneously recorded depreciation twice. So twice. By the way, this is still a mix because when you record depreciation, debit depreciation expense nominal, credit accumulated depreciation, which is real account. So depreciation expense for 2020 is overstated because you have recorded it twice. The same way, accumulated depreciation is also overstated because of the double recording of depreciation. So what happens to the book value of the asset? Book value of the asset is now understated. So income statement is incorrect because expense is overstated, net income is understated. Balance sheet is incorrect because you have recorded twice accumulated depreciation, the book value is understated, so the asset is understated. Net income is understated, thus retained earnings is also understated. Now, in 2021, assuming that the depreciation was recorded correctly, your income statement is actually correct. It's not affected by the depreciation expense, which was erroneously recorded last year. However, your balance sheet is incorrect because your asset remains understated and your retained earnings remains understated. In 2022, the same thing. Your income statement is correct, assuming no errors was committed, but your asset is still understated and your retained earnings is still understated. Okay? It does not counterbalance, and it goes on until a correcting entry is made. So, in order to correct, discovered in 2020, of course, debit depreciation, no, debit accumulated depreciation and credit depreciation expense. If it is discovered in 2021, debit retained earnings beginning. Let me check. Actually, this is a mistake. The proper entry, because your net income was understated, it follows your retained earnings is understated. So your beginning balance of retained earnings is understated. So the proper journal entry or correcting entry would be debit accumulated depreciation, credit retained earnings. Kindly just correct your notes. It's debit accumulated depreciation, credit retained earnings. Because if you'll remember, because of the double recording of depreciation, our accumulated depreciation is overstated. So in order to correct, accumulated depreciation should be debited. So kindly correct your notes. If it is discovered in 2022, the same entry, debit accumulated depreciation, credit retained earnings. It does not counterbalance. Now we have here prepayment. This is the same. Okay. Okay. On November 1, 2020, an entity made an advance payment for 1 year rent. Let's just assume an amount of 120,000. An asset account was initially debited, however, no adjusting entry was made. So the prepaid advertisement account is overstated. Supposedly, by the end of the year, you're going to recognize the expired portion by debiting expense, credit, prepaid advertisement. But because no entry was made, your prepaid advertisement is overstated, your advertising expense is understated. So if your expense is understated, your income is overstated. Your balance sheet is also incorrect because your asset is overstated. You failed to recognize the expired portion. Your retained earnings is overstated. Because income is overstated, retained earnings is overstated. Now, notice in 2021 that it does not counterbalance. Your income statement is still incorrect because you failed to recognize the expense applicable for 2021. So your expense is understated. Actually, this income, sorry for the error, income is overstated. This is overstated. That's why your retained earnings is still overstated. And your asset is still overstated. Supposedly, by 2021, by November 1, 2021, your advance payment for 1 year have already been expired. So there's no asset to speak of at all. But because there are no correcting entries recorded, the same is overstated. So if you will notice, it does not counterbalance if you use asset method. And if you remember the table I presented earlier, this one, it does not only affect the current year, it also affects the immediately succeeding year. But years after that, it's not affected. Okay. So in order to correct, first, debit retained earnings, credit prepaid asset, only for the expired portion. Diba? If you'll remember, a certain portion, which is November and December worth of rent, have already been expired. That's why your income statement is overstated by 2 months worth of rent. So your retained earnings is also overstated by 2 months worth of rent. So in order to correct, you debit retained earnings only for the expired portion, 2 months. And then you credit prepaid interest in order to reduce your asset. However, if the error was discovered in 2022, you will still have a correcting entry. If you're going to compare it with prepayment using expense method, supposedly you won't have an entry in 2022 because it should have counterbalanced. But using a asset method, it does not counterbalance. So what you're going to do, debit retained earning. Now this time for the full amount. Okay, assuming you did not discover it in 2021, then you're going to debit retained earnings for the full amount, because by this time your prepayment has been fully expired. In 2021, beginning, okay, only 2 months have expired. So there's actually, you have 2 months retained earnings worth of expense. But in 2022, all the full amount have been expired already. So debit retained earnings in full. And since it's already expired, there's no need to recognize any asset at all. So you credit the prepaid asset in full also. So this is a sample comprehensive problem. This is the common way in presenting a problem in prior period errors. Normally, it asks you to compute the net income, adjusted or corrected net income, or the corrected retained earnings. In this case, I only have the retained earnings. So this problem is actually adapted from the book Intermediate Accounting Volume 3, 2019 edition, authored by Conrado Vallex, Jose Peralta, and Christian Ares Vallex. No copyright infringement is intended. All credits pertaining to this problem is rightfully theirs, rightfully to the authors. So an entity reported the following income: 3 million, 4 million, 3,500,000. Then you have the additional data. Okay. So the best way to solve this type of problem is you create a table. One column for 2017, one column for 2018, and one column for 2019. You write the income, the erroneous income on top, and then you add or deduct the effects of these additional information. So to show, you have the following. So you have the income on top, erroneous income, then you have the following. Overstatement of 2017 inventory. So if the ending inventory for 2017 is overstated, ending inventory net income is directly related, then net income is overstated. So what you're going to do, you deduct in order to correct. Now, your ending inventory for 2017 becomes the beginning inventory for 2018. That would mean for 2018, beginning inventory is overstated. Beginning inventory and net income is inversely related. So your net income is understated. Beginning inventory overstated, net income understated. So in order to correct, you add the 120,000. You'll notice there's no effect in 2019 because it is counterbalanced. Understatement of ending inventory in 2019. Of course, it's 2019. It does not affect 2017 and 2018. It's understated. Ending inventory, net income is also understated. So, add in order to correct the understatement. Accrued interest payable. So, your accrued interest payable is understated. That means your expense is understated. As a result, your net income is overstated. Okay. So in order to correct, you need to deduct. And then, because you were not able to recognize the expense here, then presumably the entity recorded all the expense here. So the expense is overstated for 2018. If the expense is overstated, then net income is understated. So in order to correct, you add. Then same concept for overstatement of 2019 accrued interest payable. You add. Because expense is overstated, then it follows net income is understated. So you add in order to correct. Notice the pattern here for counterbalancing errors. Deduct, add. Add. In 2020, that would be deduct. Right? Because your ending balance understated would mean the beginning balance for 2020 is also understated. So if the beginning balance is understated, net income is overstated. So in order to correct, you deduct. So add, deduct, deduct, add, deduct. However, when it comes to depreciation in non-counterbalancing error, understatement of 2018 expense, that means net income is overstated. So you deduct. Does it have any effect on other periods? No. For depreciation. Overstatement of depreciation, meaning expense is overstated. It follows net income is understated. So in order to correct, you add. And then you get the corrected income. So you try to solve problems in the book in order for you to exercise. And that's all for prior period errors. We'll have the next topic posted in the YouTube.